If you decide to start a business, how do you set up your business? That is, what are the legal forms of business organization? Well, the simplest one is what's known as a sole proprietorship. And it's a business that's owned by one person and operated for his or her own profit. In fact, you may have your own sole proprietorship and never thought about it. You may have a small business on the side where you do some work for somebody. Maybe you do some baking for other people. You get paid. Okay, assuming you file a tax return and you pay tax on that, you file as a sole proprietorship. Whatever money you make, you file on your personal income tax, and you can deduct whatever expenses you have. In the case of college professors, we oftentimes do consulting work, or we do reviewing, which we may get paid for. Generally, we'll set it up as a sole proprietorship. That is, if I receive a little bit of money for doing some sort of reviewing work for some publisher, they'll send me a check. I'll deduct whatever office expenses are appropriate, and I'll just file it on my personal income tax. And in the case of a sole proprietorship, it only lasts as long as the sole proprietor is alive. So the person may have a business, but if they pass away, the business doesn't die, but technically the sole proprietorship does. So that person may pass their grocery store or their bagel shop on to their spouse or their children, but it's no longer the same sole proprietorship. The second type of legal form of business organization is a partnership. And that's a business that's owned by two or more people and, again, operated for profit. Now, there are a couple of ways you can set up a partnership. There's a general partnership. In this case, all partners have unlimited liability, and each is liable for all the debts of the company. Now, people tend to get confused about this. In a general partnership, it doesn't mean that the profits are split 50-50. The profits could be split 70-30. But the 30% owner is still liable for all of the debts of the company. So if the 70% owner can't pay, the 30% owner is not only responsible for 30% of the debts, but is responsible for 100% of the debts. Both partners are. The second type of partnership is a limited partnership. And when you have a limited partnership, you must have at least one general partner who's responsible for all the debts of the company. Limited partners' liability is limited to the amount they've invested. A lot of sports teams are set up as limited partnerships. If you know of the New York Yankees during the days of George Steinbrenner, they used to talk about Steinbrenner a lot. A lot of times they would talk about him being the owner, but more correctly, he was the managing general partner. If you're out on the West Coast and you happen to be an Oakland Raiders fan, you may be familiar with Al Davis, who was the owner, or actually the managing general partner of the Oakland Raiders. He had limited partners, people who invested money in the business, but had no real say in how the business was run. Today, I believe Stephen Ross, who owns the Miami Dolphins, has a number of celebrity limited partners. I believe tennis players Venus and Serena Williams are partners, or part owners, they like to say, but limited partners in the Miami Dolphins. Now, they don't go there and make business decisions. They simply invested some money in the Miami Dolphins, and they'll go to some of the games and sit in the owner's box, but they don't sit in on the business meetings making decisions. Any money that the business makes, that the Dolphins make, they'll get some cut of the profits, but that's basically it. They're a limited partner. Should the Miami Dolphins get sued, and should there be some large liability, the Williams sisters' liability would be limited to the amount they've invested in the business. A common form of ownership that you hear a lot about is the corporation. A corporation is an entity created by law. It's a separate legal entity. Okay, it has legal powers of an individual in that it can sue, it can be sued, okay, and it can make and be party to contracts. It can acquire property in its own name, etc. There are a couple of ways you can set up a corporation. An S corporation is one, are corporations that elect to pass corporate income, losses, and deductions and credit through to their shareholders for federal tax purposes. So the corporation is not taxed as a separate legal entity. They just pass on the funds to the owners of the corporation, the shareholders. Okay, the point in setting up a corporation is, again, to limit liability. If you're a sole proprietor of a bagel shop and someone gets sick and gets food poisoning and gets very sick from eating one of your bagels, you can be sued, and depending on the size of the suit, it's possible that they could come after your personal assets, such as your house and your car. In the case of a corporation, individuals who own shares in the corporation are not liable for more than they've invested. So they're kind of like limited partners in the partnership. So the only thing they can lose is what they've invested in the business. The more common type of corporation is the C corporation. And that's one where it's set up so that it's a separate legal entity. It pays its own income tax, and then it may pass on dividends and other distributions to its owners, to its shareholders, who are also taxed separately. Okay, so the corporation is taxed separately from the owners, and if they distribute a dividend, owners, those shareholders, are also taxed on those dividends. But the corporation is a separate entity that files its own tax return. Okay, the third type of form of business organization that you may have heard of is a limited liability company, and it's a hybrid, kind of a combination of a corporation and a partnership or sole proprietorship. An LLC, although a business entity, is a type of unincorporated association. It's not a corporation. Okay, the primary characteristics of the LLC is that it has limited liability, and the primary characteristic of it being much like a partnership is that the money, the income, is passed through to the partners for taxation purposes. So you have that limited liability of the corporation, but you're also passing through income as you would in the case of a partnership. Okay, here's a table that summarizes the strengths and the weaknesses of both. In the case of a sole proprietorship, the owner receives all the profits and sustains all the losses. Okay, it's very low organizational cost. Essentially, it doesn't cost anything to set up a sole proprietorship. Again, if you do some business on the side and you get paid for it, you're a sole proprietor. Okay, you just report that on your income tax. Quite easy to do. You have that independence. You have secrecy. Okay, I don't have to report anything except my earnings on my tax return. I don't have to tell people what I'm up to. I don't have to file any reports with the SEC, okay, etc. Okay, easy to get rid of the business. Okay, I could just decide I just don't have this business anymore. Okay, partnership. One of the strengths is that it's much like a sole proprietorship, but you have at least two people in it, and you can raise more money because you have more than one person. So the amount that the business is worth, or the amount of capital the business can raise, is not limited to the owner, the one owner's wealth, but to the two or three or however many partners you have wealth. Okay, borrowing power is going to be enhanced by having more owners. Okay, other advantages of having, more than one person working in the business, that you have perhaps people with different skill sets, different abilities. Okay, so that can be a big advantage. Okay, and again, the money is taxed on each partner's personal tax return. So it makes it quite simple to do that. The company doesn't have to file its own tax return. For a corporation, the big strength is that limited liability. That is, the people who have shares in the corporation, all they can lose is the value of those shares. Okay, they don't have to worry about their house being at risk or other assets of theirs being at risk. They can raise a lot of money. They can issue stock. You may have heard of an initial public offering. Google, Facebook, Twitter, many large companies have initial public offerings where they go from being a private company to a public company. They sell shares of stock or shares of ownership to the public, and they can raise, tens of millions, hundreds of millions, even billions of dollars. Okay, very difficult in a partnership or a sole proprietorship unless you happen to be very, very wealthy. The life of the firm, essentially, the corporation lives on forever, okay, until it's dissolved. In a sole proprietorship, if the proprietor dies, that's the end of the sole proprietorship. But in the case of a corporation like IBM or AT&T, it can live on forever. Shareholders die, they just pass their shares of stock to their heirs, the company lives on. Corporations oftentimes hire professional managers, and they usually have better access to financing. Well, what are some of the weaknesses? Well, the weaknesses of the sole proprietorship is that unlimited liability that the owner has. If someone gets hurt in your business, you could lose your house, your car, your savings, okay, depending on the rules of the state in which you reside, but a person can come after your personal assets. Okay, you're limited in how much money you can raise. It's limited to really essentially how much money you have and how much someone will lend you. A sole proprietor has to know everything, has to be a jack of all trades. Okay, that can be difficult. In this complicated world, it's difficult to know enough about everything to run a business well. Okay, and it's difficult to give employees long-run career opportunities. Hey, this is my business, you work for me. Okay, so probably if I'm going to hand over the business, I'm going to hand it over to my heirs, to my children, where someone working for me may want to leave because they don't have the same prospects of moving up the ladder. And of course, a lack of continuity. I mentioned that before. If the proprietor dies, that's the end of that sole proprietorship. Partnership, some of the same shortcomings. Owners have unlimited liability. Partnership is dissolved when a partner dies. So if there are two partners and one of them dies, the business may still exist, but the partnership technically doesn't exist anymore. Doesn't mean that the bagel shop has to close up, but you have to change the terms of the agreement. Okay, you don't have a partnership. It may be a sole proprietorship now. It may be a different partner. Maybe perhaps it's the son of the person who's the partner who's deceased. Okay, it's difficult to liquidate or transfer a partnership. Okay, how do you get out? Okay, what if your partner doesn't want to or have the resources to buy you out of your shares? Okay, that's hard to do. But perhaps you don't want to work together, or one of you wants to retire and move on. It can be difficult to do that. Corporation also has weaknesses. Okay, taxes are generally higher because of corporate income. Corporate income is taxed, and dividends are also taxed. Sometimes you hear about that term, the double taxation of dividends. It's more expensive to organize. It can be subject to greater government regulation. And if you happen to be a public company, okay, public corporation, you lack secrecy. You have to file disclosures with the SEC, with the Securities and Exchange Commission. You may have to have audited financial statements. People know how much money you made. They know how much the CEO gets paid. Okay? Nobody has to know how much the sole proprietor got paid for running his bagel shop. But you have to disclose the compensation for the CEO of a corporation. You have to disclose other things you're working on and what you're using the money for, because you're a public company and shareholders have a right to know how their resources are being used. Okay, last, let's take a look at a little table here, which I borrowed from a textbook. I'm not sure what year this is for, but you'll get a basic idea. Number of sole proprietorships, 17.6 million. Okay, 1.8 million partnerships and 4.8 million corporations. So 73% of all firms are in the form of sole proprietorships. They're small businesses. Okay, people like college professors doing consulting, people like small-time people that may be doing baking and catering out of their kitchen at home. Total receipts, this is in billions, 969 billion for sole proprietorships. Okay, 17 trillion for corporations, right? 17, that's 17,000 billion, which I believe is 17 trillion. Okay, so corporations, even though they make up a much smaller percentage of all firms, they clearly make up they're much larger companies. They take in a lot more money. They take in 89% of all the receipts, even though they're only 20% of all the firms. But again, how you set up your business determines how much liability you have, your access to the capital markets in terms of raising money, and it's a decision that owners and firms have to make.